Imagine a business model where your success is literally the company's biggest liability. Imagine a world where a firm gives you $100,000 of their money to trade, tells you that you can keep 90% of the profits and covers all your losses. Sounds like the ultimate shortcut to financial freedom, right? This is the world of proprietary trading firms, or prop firms. In the last few years, this industry has exploded into a $12 billion juggernaut. It's marketed as the democratization of Wall Street, a way for the little guy to trade big capital without risking their life savings. But there's a dark secret buried in the terms and conditions. The math is rigged. The accounts are often fake, and the entire industry is built on a statistical certainty that you will fail. In fact, if you actually succeed, many of these firms don't even know what to do with you. Today, we are peeling back the curtain on the $12 billion illusion. We're looking at how demo accounts are sold as live funding, how the rules are designed to trigger blow-ups, and why the prop firm industry is currently facing a massive regulatory reckoning. What is a prop firm? The sales pitch. Before we get into the scam side of things, we have to understand what these companies claim to be. Historically, a proprietary trading firm was a high-level institution. Think SMB Capital or Jane Street. They hired Ivy League grads, paid them a salary, and let them trade the firm's actual capital. If you made money, the firm kept a cut, and you got a massive bonus. Then came the retail prop firm revolution. Companies like FTMO, MyForex Funds, and the Funded Trader changed the game. They told the average person, you don't need a degree, you just need to pass an evaluation. The pitch is simple. The challenge, you pay an entry fee, say $500. The goal, hit a 10% profit target on a virtual $100,000 account without losing 5% in a single day. The reward, once you pass, you become a funded trader. You get a live account and you keep 80 to 90% of the profits. To a struggling trader, this is a godsend. Why risk $500 of your own money to trade a tiny account when that same $500 can give you the buying power of $100,000? The $12 billion math, where the money really comes from. If these firms were actually giving out hundreds of thousands of dollars to strangers on the internet, they would go bankrupt in a week. The average retail trader loses money. Statistically, 95% of traders fail within their first 2 years. So how does an industry generate $12 billion in volume? It's all about the fees. These firms aren't hedge funds, they are data and fee processing machines. The business model isn't built on trading profits, it's built on evaluation fees. Let's look at the numbers. A typical firm might have 100,000 people sign up for a challenge in a month. At $500 a pop, that's $50 million in revenue before a single trade is even placed. Out of 100,000 people, maybe 5% pass the challenge. That's 5,000 funded traders. Now the firm has to pay them out, right? Not exactly. Most of those 5,000 traders will blow their funded account within the first month because the pressure of trading big money causes them to over-leverage. The industry term for this is churn and burn. The fees from the 95% who fail pay for the tiny payouts of the 5% who succeed, leaving a massive profit margin for the firm. In short, you are not the trader, you are the product. The live account lie. This is where we move from predatory business model to potential scam territory. When you pass your evaluation and get your funded account, you see a balance of $100,000. You see price charts moving. You see your profits ticking up. But in many cases, that money isn't real. Most retail prop firms keep their traders on demo accounts even after they are funded. Your trades never hit the actual market, the interbank market. They're just numbers on a screen. Why does this matter? If you aren't trading real money, where does your payout come from when you decide to withdraw your profits? It doesn't come from the market. It comes directly from the registration fees paid by the new traders who just signed up for a challenge. Does that sound familiar? In the financial world, using new investors' money to pay out old investors is called a Ponzi scheme. Regulators like the CFTC in the United States have started to take notice. In 2023, one of the biggest players, MyForex Funds, was frozen and charged with fraud. The regulators alleged that the firm was actively betting against its traders and using virtual environments to deceive people into thinking they were professional traders when they were actually just playing a high-stakes video game. The rulebook rigged for failure. If the goal of the firm is to collect fees, they need to make sure you fail, but they need to make it look like it's your fault. They do this through a web of hyper-specific trading rules designed to trigger an automatic disqualification. The daily drawdown. This is the silent killer. If your account drops by a certain percentage from the previous day's equity, you're out. This doesn't just include closed trades, it includes open floating losses. If the market spikes for a split second and touches your drawdown limit, your account is closed instantly. The inconsistency rule. Some firms have consistency algorithms. If you make too much money on one lucky trade, they can deny your payout because your trading style wasn't consistent. News trading bans. Many firms forbid trading during high-impact news events like the NFP, non-farm payrolls. If you forget to close a trade 2 minutes before a news release, you lose the account. Hidden commissions and slippage. On a demo server controlled by the firm, they can artificially increase the spread or slippage. You might click sell at 1.1000, but the firm fills you at 1.0995. Over hundreds of trades, these micro-thefts make it statistically nearly impossible to hit your profit target. The B-book conflict of interest. In the world of brokerage, there is A-book and B-book. A-book, the broker sends your trade to the real market. They make money on commissions. They want you to win, so you keep trading. B-book, the broker takes the opposite side of your trade. If you lose $1,000, they make $1,000. Most prop firms operate on a B-book model. This creates a massive conflict of interest. If a trader becomes too good, they become a threat to the firm's bottom line. We have seen countless reports of successful traders having their accounts flagged for prohibited strategies, their payouts delayed for manual audits, or their accounts simply banned without an explanation. The firm's logic is simple. If we pay this guy $20,000, that's $20,000 gone from our pockets. But if we find a reason to disqualify him, we keep the money. The social media hype machine. How did this get to be a $12 billion industry? Look no further than Instagram and YouTube. The prop firm industry is fueled by affiliate marketing. Influencers get a 10 to 20% cut for every person who signs up using their link. You've seen the videos, a 22-year-old standing next to a rented Lamborghini holding a payout check for $50,000. They tell you that the banks don't want you to know this. What they don't tell you is that they make more money from their affiliate links than they do from actual trading. They are incentivized to keep you in the cycle of fail, rebuy, fail. They sell the dream, while the prop firm collects the toll. The regulatory crackdown, the end of the party. In the Wild West era of prop trading is coming to an end. In late 2023 and early 2024, the industry hit a wall. MetaQuotes, the company that owns MetaTrader 4 and 5, the software almost everyone uses, started cracking down on firms operating in the U.S. without proper licenses. This caused a prop-pocalypse. Major firms had to freeze operations, move to offshore jurisdictions, or switch to inferior trading platforms. Governments are starting to ask, if these firms aren't actually trading in the market, Aren't they just unlicensed gambling houses? In many jurisdictions, that's exactly what they are being labeled. If you are betting on the price of a currency in a simulated environment and the house is paying you out of other people's losses, that isn't financial services, it's a casino, and casinos require much stricter regulation than these firms are prepared for. Can you actually win? Now, I want to be fair. Is every prop firm a total scam? Not exactly. There are reputable firms, like FTMO, that have been paying out for years and have built a massive reserve of capital. For a very small percentage of disciplined, professional-grade traders, these firms can be a legitimate tool to scale. But you have to treat it for what it is, a high-stakes game of skill with the odds heavily stacked against you. If you want to try your hand at a prop firm, you need to go in with your eyes open. Assume the money is fake. Only trade with money you can afford to lose, the fee. Read every single word of the rules. The inconsistency rule, or trailing drawdown, will kill your account faster than a bad trade. Don't leave a large